So just to get started, if you can see the screen. So just as a quick introduction, and I'm going to keep it as brief as I can, just because I want to make sure that we get to our speaker. My name is Jean Jo. For those of you who don't know me, I'm the broker and owner of Perisson Real Estate. It's pronounced like Harrison with a P. Perisson comes from the Greek word for abundance and overflow. And our company's vision from the very beginning is, we were founded in 2016, and I really wanted to base it on this principle of abundance and overflow, that we live in plenty and that we can share with others. And as an outflow of that, we've been doing seminars pretty much ever since we started the company. Did in-person for a long time, went Zoom as everybody else did during COVID, and then we're doing Zoom seminars mostly, but for some of the important topics that I think people would really like to come out to, we're starting the in-person. So I'm really thankful that you're here today. I really believe in this principle of abundance, so have invited even fellow real estate agents here and to bring one or two clients. I knew we had a full group, so I was like, don't bring too many, but I did want to share because I think it's important that we get the information out. A quick disclaimer, this seminar is being presented with the intent of providing information to our clients and neighbors, but it's not meant to be specific advice. So again, contact your attorney. If you like what John has to say, I'm sure you'll want to contact him or your tax specialist before you make any decisions. So with that, I'm going to try to speak fast in terms of a real estate market update because I'm a real estate person and I have to talk about it. So the first thing is the slide's median sale price of single-family homes in San Mateo County. I'm not sure if I'm blocking. So median sale price of single-family homes in San Mateo County. When we talk about median sales, we're talking about basically where's the point at which the same number of homes sold above that price as below it. That's basically all that we're doing when we say median. And so as you can see here, this goes all the way back to 1999. You can see a little bit of the dip coming down. That's where I started real estate, 2008. And then ever since then, up and down, but a steady stream upward. We did peak last year in April of 2022. And since then, it has gone above 2.2, so it was about 2.25 million as a median sale price. Just kind of sit with that and go, okay, have more, the same number of homes sold above 2.25 million as below it for single family homes. It's pretty stunning just to think about it. Since then, we did, toward the end of last year, starting about June or July, things did start dropping a little bit because of interest rates. As everybody knows, the Fed started increasing the interest rates, mortgage rates, people saw go from 2s and 3s all the way up to 6s and 7s, almost over, like within a month period. So the market did slow a little bit, kind of dipping down, and then we had a good spring, and we're kind of recovering. We're not as high as last spring, but if you look at it, this is where COVID was. We're still well above before COVID. So we're still doing pretty well here. In terms of months of inventory, this is if you were to take the number of homes that are on the market and calculate how long would it take to sell out, to run out of homes if we were going at the current rate. And the way to think about it is this green horizontal line, if you can see it, that's a balanced market, so that's 6 months. So if you have 6 months of inventory, that's considered a balanced market. Anything above that, you have a lot of inventory, so it's a buyer's market. Anything below that, traditionally, is a seller's market. Ever since about 2011-12, where have we been? Seller's market, right? And I know that along the way, we've had some ups and downs, and I would have conversations with even real estate agents who go, Jean, it's a buyer's market. I'm like, not really, because of the inventory, right? It did get more challenging last year, as I said, toward the end of the year, where one of the chief economists that I listened to, somebody asked him, is this a buyer's market or seller's market? And he paused, and then he said, I would say it's a difficult buyer's market, just because the inventory levels are so low that it's not really like free-for-all for buyers as well. So we've been dipping. This line here is a 2-month mark. So that's where we've been at, up and down a little bit above and below that. So inventory, we do a monthly newsletter, and I'm always talking about inventory as the biggest factor right now for us. And then days to sell. This is how long does it take when you put a house on the market until it actually gets into contract. And as you can see here, this has been hovering around here about 10 days. This is toward the end of last year. it did bump up and take a little bit longer for things to sell as buyers became more selective, and understandably so, just because the costs are so much higher. But you can see still, even at the highest, that's 30 days. 30 days to sell is not bad. I mean, that's the highest, right? So thinking about that. And then just 2 more slides. Weekly activity, San Mateo County, you can see it better in your slides. But I follow, our MLS listings actually publishes what their stats are on a weekly basis. And what I'd like to draw your attention to, this is active listings, and this is the new listings that are coming on. If you look at active listings for San Mateo County, we're significantly down. This is this year, this dark blue line. And then the other lines are, the thinner lines are 2022 and 2021. So just looking at that, again, inventory is worse in pretty much every area in this area. We're down by about 20 to 30% compared to where we should be. So the other I word that impacts us is interest rates. And I'm sure all of you have heard the Fed increase their rates by 25 basis points. Those are not mortgage rates, just to keep that in mind. So I was talking to a mortgage broker earlier today, and she said the bond market actually went up. So the interest rates actually went down a little bit. So they've been getting that. So it's just up and down. But as much as we talk about, you can see here that spike in the interest rates, right, over the last year. Still, compare that to 1981, it was at 18.9%. And one of the agents at our brokerage actually bought his house when it was at that 18%. So when people are talking about, 6% is really high, 7% is really high, that's relative to the 3 that they're used to, but it's really not a bad rate. And when I started in 2008, it was at 6%, and I was being told, this is a great rate, and that's what I was telling all my buyers, right? So it's kind of funny to me. In the field, it's the summertime. Inventory is really the big issue right now for us. So in general, inventory has been very low, and the volumes have been down. In terms of whether houses are selling well or not, a lot of that has to do with the buyers have become more selective, and so we're seeing houses that are ready to go, great locations, selling and priced well, are selling quickly, and others are not. So it's kind of a mixed bag. I try to stay away from words like weird and crazy, but colleagues that I'm talking to, I keep meeting them and they go, it's so weird. And so I'm like, okay, well, if I'm not the only one. But I do want to get to the heart of this. We have John C. Martin here, who is going to talk about estate planning, especially with regards to Proposition 19, but other things. And I was looking through the slides, and I'm really excited to hear from him. He actually spoke for a networking group of realtors for me, and a few of them all of them were very positive. A few of them already gave his information to other clients because he was that good. They were that impressed. So I'm going to go ahead and give it to John. Thank you.
Well, thank you, Jean. It's such a pleasure. Thank you. Yeah, thank you. It's such a pleasure to be here this evening. I hope everybody's enjoying their food. And as Jean mentioned, we presented to a group of real estate agents this last week. People had so many questions because this is really a hot topic. I get so many clients who are asking about Proposition 19. And so that is the subject for this evening. We're going to talk about what it is. We're going to talk about what changed. We're going to talk about what you can potentially do to save taxes for yourself and for your loved ones. But of course, we also want to talk about Proposition 19, not just in isolation, right? Because no one tax rule should ever really be looked at in isolation, but we're going to look at it in the context of your estate planning. So I'm going to talk a little bit about that. But just a little bit about myself. I'm a certified specialist in estate planning, trust, and probate law. I'm in downtown Palo Alto. I've been in practice for about 15 years, and I help individuals, families, and businesses transition their wealth. All right? And so I've been doing this, and really the goal is to help people transition wealth in a way that saves them and their loved ones money. And so I'm going to talk about that. What is estate planning? Because remember, we're talking about Proposition 19. But we want to think about it in terms of what our overall goals of estate planning are. And I know this may seem basic, but it's so important. We're going to keep on coming back to, well, why are we doing what we're doing? And then people are going to make better choices, right? And that is a main goal that we have. So it's incapacity planning, it's wealth transfer planning, and it's beneficiary protection. Incapacity planning, wealth transfer planning, and beneficiary protection. When we're looking at wealth transfer planning, and most people think Proposition 19 must all be about wealth transfer planning, right? It's about the changing tax laws, right? And estate planning is about avoiding tax. And that's really true for one part of wealth transfer planning, right? Minimizing tax. But it's also about delay. There can be a lot of delay when you're transferring wealth. There can be an invasion of your privacy, right? Because people might be able to look up and see what your children got or what your spouse got. Have you ever heard that there are some people out there who are gold diggers? Anybody heard that expression, right? Well, imagine if you could just look up and see in the paper when somebody died. This is the law, right? You publish in the newspaper when somebody died. Then they can look up and see what your kids got, right? Do you think that they could be potentially the targets of a gold digger? Maybe. I think so. Wealth transfer planning, very important, but not just tax. Also the cost, right? If you're paying attorneys a bunch of fees and they're saving you the same amount in taxes, have you gotten ahead at all? No, you haven't gotten ahead, so we need to look at everything. CPA fees, attorney fees. We want to minimize all cost. We're also looking at beneficiary protection planning. Beneficiary protection planning, very important, because if we're going to get the wealth to our beneficiaries, but it's just going to go in a lawsuit or in a divorce or in a bankruptcy, well, we haven't really accomplished our goal of transferring wealth. And so this really is going to figure into Prop 19 as well, because you're going to see that a lot of the strategies for avoiding tax have to do with getting a house or getting property over to the next generation. Well, if they're just going to lose it in a lawsuit or in a divorce, well then that defeats the purpose of the Prop 19 planning also. It's not just your kids. We've been mentioning kids, it's also each other, right? If you're a married couple, right? Because I don't know about you, me and my spouse, we've decided we're going to die at the same time, right? And we're going to die in our 90s, and we're going to be holding hands in our sleep. Does anybody have that plan as well? I'd like to die that way. I think about this sort of thing because I'm an estate planning attorney, by the way. But probably that's not going to happen. More realistically, one of us will pass away before the other. And so we have a plan, and I advise my clients to have a plan about that. What if your spouse remarries? Now, don't go home and talk about that. That's kind of an awkward subject. But we want to think about that in the context of estate planning, because if you passed away and your spouse inherited something from you and then they remarry, there's a possibility that your children of your marriage might not receive the inheritance that you've worked hard to get to them, and that includes that property tax basis that maybe you hoped you might be able to pass on to your children. So very important to think about your spouse, your loved ones in estate planning, and also incapacity planning. This comes up a lot with Prop 19 planning too. What is incapacity? Well, it's any circumstance where you or your loved one no longer has the ability to manage their personal affairs. That could be for any reason. And did you know you're appointing people in your incapacity planning to make these decisions for you? And that could include Proposition 19 planning. So we need to think about that when we're doing estate planning. How can we empower people and instruct them on what they should do and not do when and if you became incapacitated? And I want us to think about your estate too, because when we think about transitioning your wealth, protecting your assets for your beneficiaries, and incapacity planning, well, what are we talking about? We're talking about everything that you own. We're talking about all of your real estate, your investments, your retirement plans, the things in your living trust, if you have a living trust, the things outside of your trust. We're thinking about things that go through probate. Those are the things that aren't in a trust or in a beneficiary designation. We're also thinking about the things that might avoid probate, like joint tenancy assets and beneficiary designation assets like life insurance and retirement plans. All of this is what we look at in estate planning. It's a lot. And we're also thinking about probate. I mentioned how probate is public. You could go into the newspaper and see when somebody's passed away. Did you know when I started practice 15 years ago, I did a probate in 6 months. It's pretty quick. It's not that bad. And I was talking to this gentleman here about, my wife is from Maine. I talked to an attorney there, probate attorney. He said he did a probate in 2 months. The fastest I've ever done in California was 6 months. And that was because everybody signed off. They said, hey, no accounting needed. Hey, we can just waive all of the reporting. I just went straight into court. I got a hearing in 15 days after filing something. This was back in 2008, right? So it was very quick, very efficient. Jean, that was when you started real estate. Things were a lot different back then. Today, it's taking 2 years. 2 years to go through probate. Could you imagine waiting around 2 years? Why is that? A lot of it was the pandemic. You go and you file something with the court, and it's actually a month or 2 months before they've even looked at what you filed. Isn't that ridiculous, right? And then after they get the document filed, it's months before you even have a hearing. So it might be 6 months after you file a document before you even have a hearing. We've got about 4 hearings that we've got to go through for a typical probate. So just scheduling the hearings, we're going to be a couple years. But then there's a lot of other stuff, but it's more important than ever to avoid probate. More important than ever. And it's not enough just to have a trust. You also have to make sure you know what's in it, right? Because if your assets are not in that trust, you might still have to go through probate, and the courts are getting stricter about that. I don't know if you've ever had a loved one pass away, you had something outside the trust, you're still able to avoid probate because you can go to court just in a day and they get the assets in. That's called a Hegstead petition. You don't have to remember that. I'm not going to give you a quiz. But that's getting less and less available. I hate to say that. They're making things harder for us in the courts. And I mentioned incapacity planning. A lot of us assume, you know what, my loved ones, they've got this. They know what I want. I've told them what I want. They get it, right? Whether it's your tax planning or your health planning, though, you may think they know what you want, but they might have a completely different understanding. And just to sort of make this lighthearted, I've got a gentleman here, and he's sitting in his big lazy boy chair. He says, hey, I'm watching TV, right? If I ever get into a persistent vegetative state, I want you to unplug me, okay? And his wife promptly unplugs the television, right? Because, of course, he's in a persistent vegetative state already. And so when we're thinking about beneficiary protection planning, I typically divide this into 2 different kinds of risks, right? We've got general risks and we have specific risks. What do I mean by that? Well, general risk is the risk that everybody faces. When you got in your car today and you came over here, there was some percentage chance that you might get into a car accident, right? And then there's some percentage chance that that car accident is going to end up in litigation. Does anybody think that California is a litigious state? You know, there's a lot of lawsuits. People file lawsuits. What do you think the chances are that if somebody gets injured in this lawsuit or in this car accident that there's going to be a lawsuit? I'll tell you, I had a client. They had a daughter. She was, I think, 20 years old, right? Parents owned the car. And right here on the peninsula, she cruised through a red light turning right. Has anybody ever done that? I've done that. And somebody stepped into the intersection. She went over their foot. Yeah. How much money do you think that was as a lawsuit? $2 million. Do you know why? They settled. I don't want to get into all of that, but when they look at your umbrella, they're like, oh, let's just, give the umbrella. And that's what they did. It's like, gosh, that's crazy, but $2 million? That's ridiculous, right? But anyway, this is a litigious society. People file lawsuits, right? What happens if you leave an inheritance to your children and it's in their bank account and they have a lawsuit like that and they're underinsured? How do you think that lawsuit's going to be financed if they don't have that umbrella insurance? It's going to be financed out of the inheritance that you left them. So that's a general risk, but we also have specific risks. That might be something that you know right now about your family member, like that they're a surgeon and that surgeons really often get sued, right? That's a specific risk. Or you have a special needs beneficiary, somebody who really needs ongoing management of their affairs. So if you're going to be gifting a home to avoid property tax reassessment, and I'll talk about a strategy, how we can do that and still avoid reassessment. What if your beneficiary just receives that, but they can't manage it, right? Because they have special needs. So we need to think about all of these things. Now, let's get to the real meat of this of the presentation. Okay, we've got Proposition 19. What is it? What changed? Right? So to know what changed, we have to know what the law was before. Now, we're in California, and did anybody know that there's actually a really nice tax break that exists in California? It's actually nice to live in California if you own a home and you've owned it for a really long time. I think we're the only state that has something like this, right? Because we had property tax reform back in the 1970s, and Proposition 13 was passed, right? And what that does is it allows you to set your base year value, that's the value of your home when you bought it, right? Your base year value. And there's an inflation factor of adjustment of 2% per year that the state can charge. It's the county that administers this. Each year they can increase your property taxes by a maximum of 2% per year. Now, if you're wondering, well, where's my base year value? Where is it? You can look at your property tax statement. And on the upper right-hand corner of that property statement, you can see the value of your improvements, and you can see the value of your land, and there's a total. That's your base year value. That's not the value of your home. If you wanted to get the value of your home, you'd have to sell it. If you want a really good guess, you can hire an appraiser to tell you what they think it's worth, right? So the thing that also existed prior to Prop 19 was a proposition called Proposition 58. This was passed about a decade after Proposition 13. And what the voters decided in Proposition 58 was they wanted to allow people to pass on their Prop 13 base year value at their death to their children, okay? Very powerful. And then later they allowed this to happen to your grandchildren too. This is what Proposition 19 changed. But let's look at how Proposition 58 worked in practice. What the old law did was allow you to pass on your residence, no matter what the value was, to your children, child or children, and they could get your base year value, right? No matter what the value was of your residence, they could get your base year value. So if you had $1 million house, right, worth $1 million, and there's a $100,000 base year value, so you go into the property tax statement, you can see $100,000. They get your $100,000 base year value. That's easy. What if your home's worth $25 million, right? You live in, I don't know, Atherton or something like that. It's $25 million, and your base year value is $1 million. Does the government come in under Proposition 58 and say, nope, you know, $25 million, that's too much? No, they could do that. Do you know, I had a client. She had a property, and she's like, it's worth $100 million. And I'm like, I don't believe you. You know, that's a lot. She's like, yeah, and I only pay like, you know, $15,000 a year in taxes. I don't believe you. That sounds like too little. She showed me her property tax statement. She showed me her appraisal. She was telling the truth. She had this, it was this third generation property. And it was enormous. And it's in this area that I think developers want to come in and they just want to develop everything, right? This thing's incredibly valuable. Under the old law, she could have passed on that property tax basis to her kids. They'd be paying $15,000 in a place that's worth $100 million. Do you guys think that that's fair? No, wait, don't answer. That's philosophical. We don't want to go there. But that's amazing. That illustrates the power of the old law, right? Now, there was also another exemption that was available under Proposition 58. It wasn't just your residence. It was also all other real property. So you got your residence, that's where you live. But then everything else, you've got rental properties, commercial property, you got your vineyard, you got your cabin up in Tahoe, right? So all of these were your other property. And under Proposition 58, the law allowed you to pass on $1 million in base year value to your children. $1 million in base year value, not fair market. So remember I mentioned, you know, this $100 million place? I said it was $150,000 in base year value. If that was rented, then that would have qualified also because it was not the fair market they were looking at under the old law, it was the base year value. If that was $150,000, you would have been good. So there was a lot of people who have family-owned business, right? Under the old law, maybe they, I don't know, I talked to a colleague, he said he worked with somebody who had a floral shop. And the floral shop, they work out of a $5 million building, right? And it's second generation. But when it goes to their kids, I don't know if they're going to be able to afford to run that floral shop out of this building, and I'll tell you why in just a little bit. But under the old law, they could, because the kids could get that base year value, right? Now, Proposition 19 came along and they changed that. This came on the ballot in 2020, okay? A lot of people voted for it. A lot of people were looking at the senior benefit and they voted for it. They really weren't looking closely at the loss and the parent-child exemption. So what did it change? Proposition 19 did two things. Number one, it expanded the ability for seniors. What do I mean by senior? I mean somebody who's 55 and over, I don't know. That seems pretty young to me, but that's the definition of a senior under the law. And number two, it limited the ability to do a Prop 58 transfer. I just realized I forgot to talk about what the old law was for senior transfers, because I think this is pretty important too. The old law allowed a person 55 or over to sell their principal residence and to buy a new one and to transfer over their base year value, but had to be within the same county, or there were participating counties, right? And it had to be a home that was equal to or lesser value than the home you were selling, right? So if you wanted to buy, if you're a senior, you want to buy a more expensive home, under the old law, you're actually pretty limited. You wouldn't be able to do that at all, right? You'd have to buy a equal or lesser. We had people who, they wanted to go up to wine country. And they said, can I do that? Can I sell my home, go to wine country, and get my base year value transferred over? Sorry, that county doesn't participate with San Mateo County, so do you want to go to Placer County? You know, and people would be like, not really. I wanted to go to wine country. And say, I'm so sorry. You know, you're not going to be able to transfer your base year value. And they could only do it one time. How many times have you met somebody who they decided, hey, I'm going to sell my home. I'm going to go live closer to my grandkids. And I want to do that. What about, though, people who say, hey, I want to sell my home in the city and I want to go to this beautiful rural area. It's going to be great. And my grandkids will come visit me, right? So then they sell their home here and they go out, they move to this beautiful rural place. And their grandkids come once and then they don't ever come again. And they're like, oh my gosh, I really regret making this decision, right? They wouldn't have been able, though, under the old law to transfer that base year value again. They would have been stuck. So Proposition 19 fixed these problems. It said you can do this base year value transfer now as a senior 3 times. 3 times. That's a lot. You know, you can sell your home, buy that rural paradise, change your mind, move back to the city, and then do it all over again. I think that sounds great. That gives a lot of options to seniors. But also, they said you can sell your home and buy a replacement home, and that replacement home can be a greater value, right? So this provides a lot of flexibility for seniors. They don't need to have a home that's equal to or lesser value anymore. But it changed the Proposition 58 rule in a major way. Here's what Proposition 19 does if you want to transfer something to your children. It says, sorry, you don't have the all other real estate exception at all. That's gone. You can pass on your personal residence, right, the home that you live in, but it has to be owner-occupied when you pass it on, and then your child has to owner-occupy when they receive it. They have 1 year to decide if they owner-occupy, right? And if the home is over $1 million in value, we're not talking about base year value, we're talking about fair market, then it's going to be reassessed for the amount over $1 million. Let me give you an example for how this works, okay? Let's say you have, and I like to call this the Goldilocks scenario, okay? Mom has 1 child, and mom owns a home in California that's worth $1 million, and her base year value is $100,000, right? And mom dies, and then within a year, daughter decides, I'm going to move into the house, I'm going to owner-occupy. Goldilocks scenario. Because daughter moved in within the year, it's $1 million. Mom was an owner-occupier. She's an owner-occupier. There's no reassessment. That works. So how many times have you seen Goldilocks scenarios, right? You know, in your life, probably it's rare to see that. Usually the home is over $1 million. You've seen a lot of homes worth less than $1 million on the peninsula, right? They're worth a lot more. A lot of people have siblings, so are they going to come in and they're going to split the house with their sibling? Right? And what if they decide to move out at some point in the future? You know, it's not like a tax-deferred exchange where you get a home and then you decide you're going to rent it and then 3 years later you move into it and the IRS is okay with that. No. With this, if you move out as the child, county's going to come in and reassess daughter later at fair market. So very limited under Proposition 19. So let's say the house is worth $1.5 million. You know what they're going to do? They're going to send out an assessor, first of all, to determine that. Then and they're going to add that $500,000 base year value to your taxes. So under our Goldilocks scenario, now we just increase the value to $1.5 million, right? So you get that $100,000 that mom had, and you add $500,000. Now we've got a $600,000 new base year value. Questions at the end. So a lot of people are thinking, oh my gosh, did I miss the boat? Did I miss the boat? Because after Proposition 19 was signed into law, a lot of people rushed over to their attorneys to try to transfer property to their kids. Rushed. In fact, I did 99 property transfers over a 3-month period. Talked to all my colleagues. They were busy. They were turning away clients. They say there's not enough lawyers. Anybody here ever heard somebody say there's not enough lawyers? At that time, there was not. But there's still planning opportunities that are an option. So I wanted to show also how the base year transfer works for seniors, okay? Because remember, you can buy a home that's equal to, greater than, or less than your home that you're selling. And now you've got 3 years to get this replacement residence as a senior. That's a good amount of time, right? And there's going to be a calculation that takes place to decide what your new tax bill is going to be. So let's use some really nice round numbers. Let's say that you're over 55 and you own a home that's worth $1 million. $1 million. Your base year value is $100,000. Okay, but you're like, I want to upgrade. I want to have a $2 million house. Jean's going to help me find this. It's going to be great. I'm going to have it. It's kids are going to move into an in-law that's there. You know, but what's my new property taxes going to be, right? Well, let's assume you buy this in the same year that you sold your house. This makes it really easy because we know it's going to be a 1-for-1, and I'll show you how. So what the county is going to look at, they have you file this form after you have sold your house and then bought the new one. You're going to report the sale price and you're going to report the purchase price, okay? They're going to look at that sale price. They look up your property taxes, okay? And for that first $1 million, you get to port over your $100,000. Okay? Now, in our example, there was a $1 million difference, right? So then what they're going to do is they're going to add that $1 million to your tax bill. So now you're going to have $1.1 million on your new replacement residence. That's actually a lot better than a $2 million basis, right? Because if you had a $2 million basis, what are you paying in property taxes? You're paying about $20,000 per year, but with a 1.1 property tax basis, you're paying $11,000 per year. That's a big difference, and it's every year that you're paying for it. Now, I also wanted to mention that Proposition 19, maybe you saw the advertisements. You saw that people who lose their home in a fire were going to be benefited by that law, and that's true. Because not only do seniors have this benefit under Proposition 19, but also people who lost their home in a fire now can also transfer their property tax basis. So a lot of people were really disgruntled when they found out about this law. And they said, how did this happen? Well, you know what? I hate to say it, and no offense to real estate agents, but it was the California Association of Realtors. They came up with the law, right? But as soon as it was passed, they're already now looking at a way to tweak it. And the ballot measure that came on, it didn't get enough signatures, but what they were looking for is, can we just keep that benefit for seniors, all that flexibility, but get rid of the change with Proposition 58 being repealed? Sounds like a nice fix to me. So when that comes up, you can take a look. So what if, though, you're thinking, oh my gosh, I missed the boat. Are there any planning opportunities? So I'm going to share with you a strategy that exists. And actually, before Proposition 19 became law, I was doing this for clients that had more than what they could pass on under Proposition 58, right? They had property that was too valuable, and so they had this planning opportunity available to them. But now this planning opportunity is available to people who just, they have other real property. Maybe it's in a business, or maybe it's a property that's being rented. And they want to be able to pass that on to the children, they're wondering how they can do it. So first, remember we looked over what was estate planning, what were the goals that we're trying to accomplish, right? Because if somebody comes to me and they're like, actually, I don't think my kids want this property, well, then I'm not going to be spending time on saving them property taxes, right? Well, that'd be ridiculous. You know, I just had a client this last week, and he's like, oh, if I could save property taxes, this would be great. I'm like, well, we have a strategy that's available for you. And I'm like, do you think your kids would like to continue renting out this property? He's like, oh, that'd be great. You know, I could get great rental value if they could keep the low property tax basis. And I'm like, well, do you think your kids would be happy to be in business with each other, you know, running a rental property business? He's like, oh, well, yeah, I could talk to my son about that. I'm like, well, are you going to be talking to your daughter? Well, no, I'm just going to talk to my son. Like, well, I think there might be some reason why, you know, you're probably not. Well, yeah, no, she wouldn't want it. She would not want to be part of business with my son. That's true. Yeah, and I didn't go there, you know, but I could tell there were some real issues with communication, right? Actually, the daughter wasn't even talking to the son. So I don't think they're going to be able to carry on a rental property business together, right, after mom and dad die. In fact, I think this is going to probably lead to dispute. People have disputes all the time after their parents die, and we're trying to identify that and avoid it in the estate planning process. We're also going to look at other taxes. Did you know that the greatest tax benefit you'll ever receive, you have to die to get? I'm sorry to break the news to you, but this is called the step-up in basis for federal capital gains tax purposes at death. Step up in basis. This is huge. You know, this is a different kind of tax. I'm talking now about federal capital gains tax, right? Let's say you bought a home. You know, I have clients that bought their home in Palo Alto back in the 70s. And they still have it. Some of these homes are worth like $10 million. And they bought their home in the hundreds of thousands. And it's just unreal, the appreciation, right? If they sold their home today, they didn't do any remodeling or anything, right? Just very simple numbers. We're talking about a capital gains tax that's enormous. The difference between a couple $100,000 and 10 million times 20% times 9%, right? Because that's the combined federal and state capital gains tax rate. That's an enormous percentage that's going. And you're like, 20%? No, because I'm not in the top tax bracket. Yes, if you're selling a $10 million home, you're going to be in the top income tax bracket, okay? This is a lot of taxes. If that senior passes away owning that home, do you know what happens to their cost basis? It adjusts to $10 million. The very next day, that client's children can sell that home and pay how much in taxes? Zero. This is huge. This is a huge tax benefit. You know, we have this with married couples where one of them is starting to get really sick and they say, you know, I should sell my home and you know, we're going to downsize, we're going to do this, we're going to free up some money for caregivers. And I said, did you know you own your home and community property? If one of you passes away and then the other, the surviving spouse, sells the home, did you know you will pay zero taxes? This is huge. A lot of people don't know that. They sell their home. Then a year later, their spouse dies, right? Maybe there's some alternative. Now, sometimes there's no alternative because life happens, right? But sometimes there is. Sometimes you can get a HELOC or something and survive for a little bit longer and then sell your home. So we're trying to save money for people, okay? And this improves the lives of our loved ones when we can do this. So we want to think about, do your kids want to sell this home? We're not going to implement a strategy where they're going to sell it anyway, then they're going to be paying a lot more taxes. Even though we save property taxes, we haven't done anything for them because they're paying more in capital gains tax, right? But here is the strategy. Now, I want to tell you, and you already got the disclosure from Jean, right? Talk about your specific situation with your attorney. But I'm going to doubly warn you, please do not attempt at home. Because this is really, really very detailed, very specific, right? We've got to go through a lot of steps. We have to be very careful when we implement this. And I'm going to tell you about a strategy because I want you to know that it exists. I want you to know because this is about improving the lives of your loved ones. I want you to know that there is a strategy that exists where you can pass on real estate to your children and you can still avoid tax. In fact, you can use this strategy for somebody else, not even a child. You can use this if you have a life partner. I have couples that come to me, they're not married. And they say, what's going to happen when I die and my partner inherits my home? It's going to be reassessed. Because there's no partner exception from reassessment like there is for spouses, right? So I have this a lot for unmarried couples. So this also applies to business partners, right? This is a strategy that can apply to a lot of people. So what's the strategy? Come on, tell us already. What is the strategy? Okay, there are two different exceptions to reassessment that exist when we're dealing with business entities. Okay, the first one is that when you fund a business entity or withdraw real estate from a business entity, as long as the transfer is what we call a proportionate interest transfer, then there is no reassessment. This is what it sounds like. Proportionate interest transfer is one where the proportionate ownership interest is the same before and after the transfer. Very easy example. I own a property 100%. I have an LLC owned 100%. I have my home owned 100%, moved into my LLC owned 100%. There is no reassessment. That is a very easy to look at proportionate interest transfer because there's no underlying change in ownership, right? That kind of makes sense that law exists, right? People put their homes into LLCs for asset protection. You know, in fact, there's another exception that exists, okay? And this one is that when there is a minority transfer in the ownership interest of an entity, there's also no reassessment. So you think about, well, there's all these businesses. Let's take Coca-Cola, right? Coca-Cola has a lot of property, plant, and equipment. I don't think Coca-Cola does business in California, but let's say they did. Let's say they had a factory, right? And then you just bought Coca-Cola stock. Did they reassess whatever that small little percentage of Coca-Cola was, you know, as it corresponded to that real estate? No, they can't possibly do that. Coca-Cola shares are always trading hands every day, right? So they can't reassess that 0.0001% of that factory, right? So what they do is they say, if a company changes hands, if it changes control, we will reassess everything in the company, 100% of the real estate, 100%. So if you have a real estate partnership and it has 10 buildings and it changes hands, 100% of the real estate will all be reassessed. So I have these clients, they're real estate developers, right? They have these entities. We have to keep a very careful schedule when they're transferring their LLC and partnership interest to make sure that we don't get over 50%. Because if we get over 50% and they didn't know they were going to be reassessed, well, guess what? I just committed malpractice, right? Because then they get reassessed on everything, all their real estate that they own. But this actually presents an opportunity to us too, because we can transfer a non-controlling interest of an entity and we don't get reassessed, right? So we can combine these two strategies in a very intelligent way and actually avoid reassessment. Here's how we do it. I set up an entity for mom and dad. They own property 100%. The LLC is owned 100% by mom and dad. We transfer the property in. It's proportionate interest. No change in reassessment, right? Now I'm looking at the kids. Our kids are very successful business people. They face general risks in society. Remember I was talking about beneficiary protection? We're going to set up some trusts for them. We want to protect them from the possibility of bankruptcy, creditor claim, divorce, and lawsuits. We set up these trusts for them. And then we set up a gifting plan, gifting gradually into this LLC. And you know what? I'm also getting gift tax benefits from that because I'm able to discount the value of these interests that I'm gifting into their trust. I'm doing it gradually. Now I get up to the point where I have a non-controlling interest transferred into their trust. Let's say it's 49%. I say I'm ready to dissolve this LLC. And so I dissolve it and it goes back 49%, 51% to parents, right? This is a proportionate interest transfer. We have no reassessment. Now I go back and I reevaluate. I say, you know, I think we should do a little bit more gifting. We're going to gift a 2% interest to the kids' trust. Now the underlying interests are 51% in parents' name, 51% in the children's trust, and 49% in the parents' name. Now we set up a new partnership. The new partnership is owned 49% by the parents and 51% between these two trusts. Now parents let it go. At their death, will there be reassessment? No. Because they do not own a controlling interest in the partnership. Did everybody follow every single step? Now, we had to space it out and we had to think about something. That's why we really don't want to attempt at home. Step transaction doctrine. Did you know that there's this catch-all law that says, well, if you get this clever attorney or an attorney that thinks that they're clever, you know, and they put all these steps together, and the sole purpose for all those multiple steps was just to avoid tax, we can impose tax anyway. That's called the step transaction doctrine. So do we want to put a bunch of steps together, the sole purpose of which is to avoid tax? No, never. We would never do that. We have a memorandum and we say, oh, we're doing this for asset protection because guess what? I just outlined to you that a major purpose of what we're doing is asset protection. And guess what? We're trying to avoid taxes. We're trying to transfer wealth. Did you know that also transferring a minority interest saves you taxes because there's a minority interest? And there's a valuation opinion that can go in and say, well, that's a non-controlling interest, therefore we can discount the value. Well, that's not related to property taxes. So I just put in all these memos that give all this advice, right? So then I'm going to have a very good argument if the tax authority says, oh, we should reassess. And I've also spaced it out over 2 tax years. So we've got some advanced planning, and we have a very defensible argument. And we've just transferred how much in real estate? Well, actually, it could be any value of real estate, right? Any value of real estate. So this is a very powerful tool, and again, I want to make sure that people know about it because if you're an individual or a family and you want to keep property in the family, or maybe you've already had a step up in basis, and so there's no downside in gifting property, right? Because you know, if you gift property, you're not going to get a step up in basis because you don't own it anymore. But what if your spouse just passed away, right? What if your spouse just passed away? You just got a step up in basis. So maybe that's a good time to do it. What about a family business? You're trying to keep that business in the family. Might you consider having a strategy like this so that your business can survive to the next generation? What about somebody who's already considering gifting? They're already thinking about doing it, and they just didn't realize that they could do it in an intelligent way that avoids property tax reassessment. And another solution, of course, is to change the law. And by the way, the law may change for all of our clients that have funded things into trusts. That's why we want to predict also, well, how might the law change? And we draft trusts in such a way that we can change the trusts, right? We can change the trust in a lot of situations because we don't know if there's going to be estate taxes at your death, if there's going to be capital gains taxes at your death, if there's going to be a basis step up at your death. We actually don't really know. I'm not, a prophet, but we're going to try to put in some flexibility so that we can change things down the line. Now, Jean gave me a special request, which was, I have a 7-year-old and a 9-year-old. And so when I have this, it's endearing to me, to see this. But everybody knows what I'm talking about, when we think about kids that, maybe they didn't have the same experience as we did. We're giving them property. We talked about beneficiary protection. I see a lot of people in the Bay Area, though, that put their children's name on title, okay? And they do it as a joint tenant. And they say, well, it's going to avoid probate. There are so many things that could go wrong. I'm just going to tell you a few. One of them is that your child might die before you. Did you know that? I think it's very rare, but we do see that sometimes. Did you know that there's a transfer that's taking place, right? A taxable transfer that's taking place by the child to you, if that occurs? So we want to avoid that. What if the child has problems down the line in their marriage or with their legal affairs? What if they go bankrupt? If you add your child's name to a deed as a joint tenant and they go bankrupt, do you think that there's an exemption from bankruptcy? No, there's no exemption. Your home that you put your child on as a joint tenant is going to be subject to your child's bankruptcy estate. This does not sound like a good strategy to me. What if your property is generating rental income? Do you think this is going to be attributable to your child? Do you think it might affect their spousal support judgment that they have put against them when they're divorcing? Yes, it may be one of the factors that the court looks at. This is not a smart plan, people. Don't do this, please. There's also these other related issues, and Jean also, special request, wanted to mention that there is a $250,000 exclusion for sale of your residence, okay? $500,000 for married couples, and there is a plan to increase this, but it's not the law yet. So you have to keep this in mind. Now, remember when I mentioned step up in basis? A lot of people, after their spouse has died or after their loved one has died, like, oh, well, we have the $250,000 exclusion, so we're going to be able to save on taxes. And I said, 0 taxes. I said, well, we have the $250,000 exclusion, 0 taxes, right? Because it was a step up in basis, remember? So you don't need it when somebody's passed away. You do need it if you're selling your own residence. But remember, this is this other thing, seniors transferring their base year value. We talked about that with Proposition 19. They often overlook that when they're selling their home, Proposition 19 did not affect their capital gains taxes at all, right? When they were voting for Proposition 19, they said, oh, I can sell my home and buy a new one and there won't be any taxes. No property tax reassessment. There's still going to be a tax when you sell your home, okay? And it's that exclusion, $250,000, that counts towards the value, towards your basis. So basically just increases your basis. If you have a $100,000 basis, you can add $250,000. So now your basis is like $350,000. So you're probably still paying tax, but a little bit less than you would have without the exclusion. I also just wanted to briefly mention estate taxes. Where is the law right now, and where is it going in the future? Right now, we have the largest exemption amount from estate taxes I've ever seen, and that anybody's ever seen. There was, of course, one year where there was no estate taxes, but that's a different story. Right now, it is an inflation-adjusted $10 million. So with inflation, $12.9 million per person can be passed to anybody, right? And there's no tax. $12.9 million is a lot of money. But that law is going to expire in 2026 because of something called sunset, right? Whenever there's a measure that increases the deficit, those tax measures have to expire. So we have this expiration coming in 2026. Congress could do anything before that. You know, Congress can create new laws. The president has to sign them. So right now our government's very divided. So there's been no change in the tax law. That could change at the next election. Or maybe they have some sort of standoff. You watch while government, they shut everything down, or there's this deficit, and then suddenly you see all these changes. Well, that was some compromise that they came up with. It could actually change the estate taxes. That could be part of those compromise. But what about, gifting before the sunset? Some of our clients are doing this. So our clients that will be affected by what the law will be in 2026. The law is going to be reverting back to what it was prior to 2016, which is a $5 million per person inflation-adjusted amount. So we actually have a lot of clients that are in what we call the danger zone. The danger zone is people between 5 million and 10 million. A lot of people in this category, right? Or 10 million as a married couple, 20 million as a married couple. A lot of people in this category because they're going to be affected by the new law. So some of these people would like to do some gifting before the sunset. I also, just another thing, because I'm kind of just checking them off the list here, A-B trust. Every single trust used to be drafted for married couples as an A-B trust. Every single one. And the reason is because we didn't have an exemption amount of 12.9 million. We had one that was a few $100,000. In fact, as recently as 2001, it was $1 million, right? So people own a home, have an investment account, right? They had a A-B trust. Guess what? When you have funds that are in a B trust, right? Those don't get any step up in basis at your death. So if you don't need to save any estate taxes and you have an A-B trust, you're actually going to be paying more taxes, not less. So AB trusts should all be reformed for estates that are below $26 million. A lot of people with estates below $26 million, right? And they've got AB trusts, are like, hey, we should eliminate that. When should you do this? So your planning opportunity, I talk about, it being this narrow period. People are like, I've got all this time. I've got between now and when I pass away, right? Actually, you have between now and your incapacity. Remember we were talking about incapacity planning? Because you can't do any planning if you become incapacitated. If you no longer have the ability to manage your personal and financial affairs, you cannot designate anybody to do this for you. You have to have capacity to execute a power of attorney. So I suggest that you go home, set a deadline for yourself, set some goals, and then make an appointment with your attorney so that you can go over these things. I just wanted to give this final disclosure so you don't rely on this for specific tax advice, but I am going to be opening up for questions. Okay, we've got a great question here, which is, how does the county know? How does the county know that you've moved out of your house, right? So, has anybody ever, you record a deed, you bought a new home, you transfer something into your trust, you get something in the mail. The mail, right, comes and you've got this personal residence exclusion form that you have to fill out, and it gives you this really small break on your taxes, right? you can only claim that for one home at a time, right? Because you can't live in multiple places, right? And that is how the county tracks where you're living. It's Big Brother. They're tracking you. And it's giving you a small break on your taxes, so people, they fill it out, right? That's the incentive, so that people aren't hiding it. Without that form, they wouldn't know. So that's a good question. Does California have a stepped-up basis too? Yes. You know, if you have a stepped-up basis federally, it also applies for the purposes of California ordinary income tax. You know, California doesn't tax capital gains in the same way that the feds do. They treat it as California ordinary income, so it's your tax rate that applies, so it can be based upon California brackets. Is it correct that you have something in the will that you must include it in your trust? Something in the will. I don't know if I understand that question, but maybe this is a trust versus will question. What goes in the will? What goes in the trust? I'll tell you, we don't have anything go under your will. Everything goes under your trust. The only reason why we even have a will, though, is so that if you have assets that are outside of your trust at your death, that those can be put into your trust. We're always trying to avoid probate, right? We're also trying to avoid dispute. So if we had a will that said something different than the trust, or if we didn't have a will, we might actually have different beneficiaries under your estate than your trust. So then people might want to try to throw out the will or have a dispute. We can also go to court and avoid probate if the will names the trust. And that's a big deal because it saves money for your family. And I should stop moving.
Stay behind.
Sorry.
It's okay, just stay back.
Do all states have the same rules and regulations? No. We have 50 different states, 50 different systems of law. Do you know that I can only practice law in California? I can't practice in Nevada. So if somebody moves to Nevada, I have to refer them to a Nevada attorney, right? 50 different legal systems means it gets really confusing, right? It also means when you're looking at all your real estate and you're thinking, well, what advantages exist for me? Everything that I just said just applies to California, right? So if you own something in Arizona, right, property tax reassessment, it's going to be a completely different issue. Say you move from California to another state, right? What does each state do what they wish? Absolutely. In fact, my wife is from Maine. I mentioned that before. And they reassess property every few years. They just do it automatically. They go in and they just look at what they think your property's worth, then suddenly you get a new tax bill. Might that be difficult if property values are really going up and you're on a fixed income? Yes, that's why voters overwhelmingly wanted property tax reform back in the 70s so that seniors didn't get priced out of their homes. What is the tax rate after $5 million in 2026? Good question, 40%. So 40% is the current estate tax. It was before tax reform in 2016, and it will continue to be the tax rate. It's just that the exemption amount is going down from 10 million inflation adjusted to 5 million inflation adjusted. How do you know if your trust is an AB trust? That's a good question too, because we have alphabet soup, right? A, B. So there's different words for the B trust. Exemption trust, residual trust, bypass trust, credit shelter trust. All of those mean the same thing. So if you're reading through your trust and it has some language, there's a bunch of different ways you can do this, but most of them are, upon the death of the first settler to die, two trusts shall be established, an A and a B, and then the one half of the first spouse to die's community property shall be reserved in the A trust, and an amount not to exceed the exemption equivalent amount for the death of the first spouse to die shall also be reserved to such trust, but taking into account all property which has been received through the last one. You're like, you're just kind of, so if you have that kind of language in your trust, it's probably an AB trust. Okay, sorry. How do I put my home in a trust? A deed. How do you record that? They knew the answer to the question. How do they record that with the county office? You can actually take your deed, right, once it's been signed, and you can take it to the county office. You can record it over the county. I'll tell you over the counter. I'll tell you how I do it though. Now I send every one that's not a rush just in the mail, and it takes a couple months to get back. There's a preliminary change in ownership report, documentary transfer tax affidavit in San Mateo County that has to be filed with that too. But there's now, effective since the pandemic, e-recording. E-recording is new in California, so we can actually e-record a deed. So I use a courier, and then I can get it in the next day, and I just maybe FedExed it to them, or they pick it up at my office, and it's just a few dollars more than a over-the-counter recording. If a spouse passes away, Would the step up in basis be 50% for joint property? This person maybe had this experience, or they're a tax person. Yes. So remember, I used the word community property. In fact, this is another reason why people should talk to their estate planning attorney, because if you own your home in joint tenancy with a spouse, and a lot of people do, and actually it's usually older deeds, I see this, like pre-2010 or so. Joint tenancy, one spouse dies, only 50% of the basis steps up. This could be huge. Who wants to have a widow or widower in their office and they're like, oh, I can sell the home and move to the V or something, or Sequoias. Like, oh, you're going to have to pay a lot of capital gains tax because only 50% stepped up. But if we can transmute to community property, then you can avoid that. But transmutation is legalese for changing something from separate to community. Lots of analysis, but we just want to check those off, like what happens if you divorce, what happens if there's a lawsuit, what happens if one of you dies, and then if everything looks good, we can move it to community property, and then 100% basis step up if either spouse passes away. Under Proposition 19, in your example, after daughter moves in, so this was, I think, the Goldilocks scenario, right? Post mom's death, can she live in it for 1 year and preserve the property tax basis and move out and then rent the property? No. That was my point. That when you move in, you've got that form that you fill out, that's your personal residence exclusion form. If 5 years later you move out, there is no holding period. There's no safe harbor. The county will go in and they will reassess it as soon as you move out. Isn't that awful?
Yes.
I know. I was really bummed to learn that too. My daughter is my primary on the living trust. After she gets married and changes her name, do I have to change my living trust? I think it's a good idea. Whenever you have a change in name, I think the trust should be updated. This kind of goes to, well, what is enough to update your trust? Change in life circumstance, change in your financial situation, new assets, change in the law. Now, a lot of these things you're like, well, I don't know, I'm not sure. Well, if you don't know, maybe it'd be a good idea to talk to a professional, because what you don't know doesn't mean it doesn't exist and it might affect you, right? So you don't know what you don't know is the point. And then, there's a new one. When should a person add children in joint tenancy? That's a good age for the child. What's a good age for the child? For example, a single adult child when you are quite elderly, say 80s, and not very healthy, so you think you will only have a few more years. I still think a trust is a better way to do this, not joint tenancy. When you name a child with joint tenancy, the title automatically goes to them, right? It avoids probate. But, what if you need to fix up the home, or what if there's another beneficiary? Shouldn't there be some sort of process for administering the trust? I know nobody likes the idea of process, but think of it this way. Let's say there's somebody who contests whether or not this joint tenancy was valid. This person just said they were elderly, right? Or maybe they're thinking about somebody else. What could go wrong if a elderly person names their child as the joint tenant on the deed? The first thing that pops into my mind is, well, elder abuse. Yeah, you've got a situation where maybe this transfer wasn't valid. And this is so easy to do. I just add the child to a deed. Well, the very ease of doing it means I don't have any supporting documents or evidence to show that this person knew what they were doing, that they were advised on what they were doing, that they knew that they were, that they had capacity, that they had due execution, that it was them that signed it. When I have a trust, I have a notary. There's an attorney that draws that up. There's a notification that goes to the beneficiary at the person's death. It starts a statute of limitations of 120 days on the validity of the trust. I don't have any of that with a joint tenancy deed. So I think there's going to be so much more protection if you have a trust, and it's just on and on and on and on. So please do not do that. Should beneficiary of investments of a 403 or 401, so 403B or 401K be your trust or individual names? Well, hypothetically, we could do either. And hypothetically, you could draft a trust so that it is a valid designated beneficiary of a 401K. And what I mean by that, by saying valid designated beneficiary, is that there are regulations. These are Treasury regulations that say, well, individual, and by the way, this has changed with Secure, right? There was the Secure Act that passed a few years ago. Used to be that if you had a 401k and you left it to somebody, they could take, with some exceptions, right? They could take lifetime distributions. So you go in and there's this table that is published, and you could take that table, you take your life expectancy, you take the balance of the account, and you can figure minimum distributions, and it's for the rest of your life. So it was actually not only just tax breaks for retirees, but tax breaks for their kids too. And Secure changed that to 10 years. But if you have a trust or estate, it's actually 5 years. What's the difference between life expectancy, 10 years, and 5 years? Taxes. I think it was Einstein that said the most beautiful math equation he ever saw was tax-deferred compound interest. I think so. I think that was what maybe I'm biased, with favorite Einstein quotes. But it's a beautiful thing when you watch the value of a retirement plan going up and up and up and up and up and up. And actually that happens the longer you can defer the distributions, the more growth you're getting. You're maximizing this wealth for your family. So if the children can take out over the life expectancy, they're getting a lot of wealth. 10 years, a lot less wealth, because you got to withdraw everything in the 10th year. That's a lot more taxes. That's why Congress changed that law. 5 years, which is a trust, is much less. Now the law allows you to look through the trust and treat the children as the beneficiaries. That's what the law says. Here's the problem. There's financial institutions that will not follow the maximum possible allowed scenarios that the IRS gives you. I had a situation, I have no bias, I have no stock in Ameriprise Financial, I'm not, but they had a policy that said that they don't allow 10-year distributions for inherited IRAs. I said, well, the law allows it. No, our internal policy is we don't allow that. We require you, if you have a trust named, to distribute the whole thing in 1 year. Oh my gosh, I have a major problem if that happens. Why? If the whole 401k is withdrawn in 1 year, it's a taxable event. There's no step up in basis for a retirement plan that's a traditional retirement plan. It is all taxable. Imagine having $1 million IRA all be taxable in year 1. This is a major, major problem. So we want to avoid that. That's why I typically recommend, except for special needs beneficiaries or particular situations, to have a individual named beneficiary.
We're going to have to stop because
we have to stop because of time.
So I know we have some questions, but we can hang out a little bit more, but I do want to do some wrap up. But thank you, first of all, John.
Yeah.
So we can all, thank you.